Let's go ahead and get started. We've got quite a few people on the call. Thank you all for joining our investor monthly call. We typically do these things in order to just keep investors abreast of what's going on with the fund and then provide a little bit of color each month on different facets or different angles of our business. And this one's a special one because this is where the rubber meets the road. We're going to hear from my partner and our chief of operations, Nick Cosmas. Nick's also my West Point classmate, and I'll introduce him more formally in a minute. But we're talking about loan closing operations, which I think is actually probably the most important part of a lending business. It's one thing to approve a loan. It's one thing to get investor money, but none of that really matters when you can't even close loans in the first place. And so Nick heads that up for us, and he's done a fantastic job over the last 48 months. So that being said, a little bit about me. I'm a West Point grad. I'm from Atlanta. As soon as I was done with my active duty time, I came right back here. I've been involved in various facets of real estate as well, multiple asset classes, hotels, single family, multifamily, and of course, single family as well. And one of my favorite things to do is I teach. I love teaching, and I think these investor calls are kind of another avenue for me to teach as well. And so I teach real estate entrepreneurship at Georgia State University here in Atlanta as well. So, our track record so far, as of the last quarter, which ended October 31st, basically, September 30th. So as of October 31st, we've done about $170 million in loans so far on our balance sheet. We don't sell loans. This is all on our own balance sheet. We manage and our self-service all these loans. So we sent $170 million out the door. And then more importantly, we've got $100 million paid back, which is even better. As I like to say, any idiot can send money out the door. It's getting paid back is where the genius lies. And so far we've done 880 loans, a lot of distinct borrowers. What we're most proud of is, as of October, most of our borrowers are actually a repeat. And that says a lot about our operation. And really, I think Nick's operation more specifically, because the lending experience matters when someone's trying to borrow hard money for a real estate loan or for a real estate deal, because time is not on your side. Time is not on anybody's side. And so the reason why they come to us and the reason why they pay us a higher premium of interest is our ability to close loans seamlessly and quickly. And that's all attributed to Nick and his team and what he does. And so Nick is a big reason why we have repeat borrowers in the first place. So anyway, I always give a plug. My phone number is there. You can schedule a time with me anytime you want. I love helping people solve problems. I enjoy that aspect because real estate is the type of game where you can't afford to lose. If you lose 50% of your money in real estate, which is possible, and it requires 100% gain to get it back. And real estate is a very illiquid investment, generally speaking, and it takes time. And so we're all playing the compounding game when it comes to investing, especially in real estate lending. So anyway, I'm a big believer in not making mistakes. And so Mike Martin was a West Point grad who called me up about an apartment deal that they were looking to buy. They ran it by us, and I pointed out some key issues, mainly the repair the seller had made or said they had made. And it turned out the repairs were not done according to code. And I asked Mike, you should pull permits to verify that these repairs have been made. And it turns out the permits had not been pulled and the work was shoddy. And Mike, fortunately passed on the deal, but had he done the deal, he would have lost, several $100,000 trying to fix what the seller had asserted. And I'm really grateful I'm gratified to know that I saved him serious money. So we've got quite a few new people on the call, actually. And so I'll briefly discuss what we do, and then we'll jump into Nick's part. But we're a hard money lender. And what that really means is that we kind of operate like a private bank. So we give you, the investor, 8 to 10 to 12% returns fixed on our balance sheet. And you actually have a real claim on our balance sheet as a debtor/creditor to us. And then we take your money just like a bank, and we lend it out at higher rates. And a spread is earned. But the good news is the majority of that interest is passed on to the investor with the 8, 10, and 12% rates. And we typically like to focus on military affiliated folks, people that are kind of in our circle, in our niche, because we know that community really well. But one thing is always certain is that we always have a first lien or a senior position on these loans, meaning that we're always secured and we have a direct ability to foreclose or seize that asset to make ourselves whole in the event of a default or a problem. And so far, we haven't lost any investor money, actually, when it comes to the loans that we've made, which I think, again, speaks to Nick and Dave's efforts on managing and originating our portfolio. But perhaps the most important thing is that me, Nick, and Dave have $8 million of our own money personally invested in Trophy Point. And we take the first loss on any bad decision or bad deal that we make. I'm not aware of any funds that do that. But I appreciate that about us, because it also the partners are making are always in line or always incentivized with our investors. And so I think that's something to take into account when you're evaluating any investment opportunities, get in the game and who's going to eat their bad decisions. In which case it's us in this case. So here's our sort of monthly / quarterly report. Let me go back one slide. So in October, one of our largest months yet, actually, we lent out about 6.4 million, and then we got paid back almost 6 million as well. And so like these trends are continuing. And Nick, I don't know what you think about it, but it seems like every time we think about the fall and the winter, we think that loan volume origination will decrease because it's the winter. But that doesn't seem to be the case, right?
Yeah, I mean, it's, we always get surprised, which is, funny to say, but we do, we kind of, everyone can, read the news and, read about, kind of uncertainty in the economy. But I think for us, the most important factor is just the lack of housing inventory out there. Depending on, what economists you're looking at or listening to, rather, they say, we're about 1.5 million to 4 million or 5 million homes short in the United States. And so, our borrowers, really props to them, they're still able to find really good deals right now, a lot of distressed properties, and turn those into, revitalized homes for folks in the neighborhoods that we're lending in.
Yeah. Quick plug, or quick thing, quick note. If you have a question, feel free to raise your hand or put it in the chat or put it in the Q&A button. I think there's a Q&A button for attendees. Feel free to use any of those mediums to ask a question. We'll take questions as we progress throughout the call today. One thing that was unique that happened in September was that we got paid back more than we actually lent out. And I think that may have been the first or second month that's ever happened to us. And I actually think that's a good thing. Real estate businesses, but real estate especially, depends a lot on the credit cycle or where liquidity is in, that's being offered in the marketplace. And one of the biggest things we look for is what's going on with the liquidity in capital markets. And it sounds like, based on the numbers that we're seeing, that people are still lending. Like, obviously, Trophy Point is lending. We also need the rest of the economy, the rest of the markets to lend, the banks to lend, because the banks are the ones taking out our loans, either in the form of a refinance or our borrower is selling to somebody that's going to take and borrow money from somebody else in order to buy the collateral that we've lent on. So, the loans paid back is an equally important measure. And I'm glad to see that, the capital markets seem to be very healthy within reason. We don't see over exuberance in terms of lending and things like that. We think it's pretty disciplined, but the capital markets are still pretty healthy, and that's great for us. Last quarter, we sent $1.1 million out the door. We also added about 15 new investors as well last quarter, to bringing our total up to 211. And our assets are about 71 million as well. And at the top left, you can see our investing. So for a non-retirement account, investing between 25 to 250K gets you 8%. 250K to $1 million yields 10%. And then all of our investments above $1 million, which we have about a dozen of those investors, they get 12%. And it's all paid quarterly. Or you have the option to reinvest the money and compound your earnings quarterly as well. And then for our retirement dollars, which I think is the best deal on the planet, actually, we like retirement dollars because you're more sticky, you're more likely to stay with us, but also you get to grow your retirement portfolio without much risk and grow it at a clip of 10 to 10.5%, which is fantastic. If you think about what could happen to your money over 20 years or any significant period of time, compounding at 10%, it's a rate of return. So that's the numbers, and I'll show you the map of where we've lent as well. So the blue dots are our paid off loans, which is great, which we always love. And then the red dots are our active loans. So as of October, and the end of October, we've got about 200 or 300 active loans, and our average loan size is $200,000, which is what we love. And I think Nick may chat more about it later on why that $200,000 number is important. But we like small loans because it really spreads out the risk when you talk about a $70 million portfolio. Not one loan, certainly not one loan, not even 15, 20 loans, if they were to default, would really hurt our ability to cover our obligations with our investors. Nick, do you want to opine on why you think $200,000 loans are great for the fund?
Yeah, sure. So, in our estimation and experience so far as a fund, people, our borrowers do sometimes face challenges with the properties that they have. And what we found is that those individuals, who have, challenges with, smaller properties, smaller dollar properties, are much more resilient, right? They're able to take out sufficient cash to cover the interest payments from their W-2, their primary source of employment. They're able to let go of properties, maybe take a 5 or 10 haircut when it's only $200,000. That is $10,000 to $20,000. If we're talking $1 million property, it's a much more challenging proposition and much harder pill for folks to swallow to take a haircut of 10 or 20%, because obviously with $1 million that's $100,000 or $200,000. And then finally, if we ever did have to take over one of these properties, we could, and there's always an option, is do a fire sale. And generally in a fire sale, you're expected to get about 60% of the market value of the property. So a $200,000 property, you can almost always very quickly, within 30 days or less, sell for about $140,000. Alternative in that will replenish the company's coffers, ensure that we can repay our obligations, etc. But it actually we're unlikely to do that with property that we get at a $200,000 valuation. Actually, much more likely to rent it out. We feel that $200,000 properties are great candidates for rent. Usually, the debt service coverage ratio on those types of properties is very strong. And so for those reasons and several others, we do really like the smaller properties. And frankly, we see less competition from our competitors who maybe are larger than us. They have to deploy more dollars. They don't like lending small dollars, whereas we do, and so we're able to capitalize on that market opportunity as well.
Yeah, and to add to that, the median home price in America is like $400,000, and you think about the universe of buyers, especially in a high interest rate environment. How many buyers can afford, if let's say we lent on a $500,000, $800,000 flip, how many future buyers could afford an $800,000 home at current prevailing interest rates? It may be 2%, 3% of the population at most that can cover that type of debt service at the current interest rates. When we get involved in smaller properties, the universe of buyers, of future buyers that could take us out of our loan also dramatically increases. Like, America could probably buy, a collateral that at least covers our loan basis, right, of 200 grand or 300 grand. So that's another reason why we like it, in addition to, spreading out the risk. As you can tell by the geographies, we like areas that are heavily populated or growing areas. We stopped lending in Florida and we stopped lending in Austin because those two markets seem to have problems, but we're really not exposed that much. You can see by the blue dots that we're largely just out of them. They're all paid off. So they're, no longer an issue. But Florida, especially due to the weather, due to the insurance costs, and due to the lending laws in Florida, has just become a market that we're not really excited about anymore. So one update is we stopped lending in Florida. I think we have one loan left there, or no, 2 loans left there. But Georgia, Texas, North Carolina, South Carolina, Virginia, these areas where like a lot of people are moving to. And so we lend in those areas. Kansas City, Missouri, like these are all good areas with low property values, great from a lending perspective, at least. We have increased lending in the north, actually, by New Jersey, Philadelphia, New York as well. And all I can say really is you really can't judge them by the state in that particular example, because real estate is a local game, and those particular areas that we're in, and the dots kind of like don't really give a good idea of like the actual neighborhood that we're getting involved in. But the areas that we're in are areas with job growth, population growth, which are excellent sort of measures for understanding real estate values. over the long run, at least. As of September, we really ourselves in the yield bucket. So you have options publicly, REITs, treasuries, dividend stocks, and then emerging debt that are either international or publicly available. And so we take the 10-year annualized pre-tax return just as a measure of understanding like where we're sitting at compared to the other things that are publicly available. So the trade-off is, the publicly available products are more liquid. Trophy Point's not liquid. Your lockup is 18 months. But the benefit is that the yield is nearly double than what's available out there. And so you have to make a decision of where we sit in the liquidity against what's available out there publicly, and also add what your needs are in terms of needing the money in the future. Anyway, this is the data as of September where we sit. So we're doing pretty well. Like I said, if you have questions, please throw it in the chat in the Q&A buttons. We'll answer them as we go. I've already discussed this. If you wanted to invest more or wanted to invest, these are our rates based on investment amount, the rates for retirement. One new update is that we're getting rid of but we're suspending the 12% by the end of the year. I mean, we may extend it by a month because some people have asked for it, but after January 2025, we're going to suspend accepting money for the 12% program. So anyone that's invested into it now will be grandfathered in and we'll honor the 12%. But as interest rates decrease, as evidenced by the 50 basis points rate cut that happened last month, we see a scenario where rates are going to decrease. And so we're going to have to curtail the highest income producing rate that we offer, which is the 12%. So if you're thinking about hitting the 12%, now's the time to do it, because we're going to suspend it at the end of December, but definitely by the end of January. And if you need like an extra few weeks, just contact me and I'm happy to make an exception. All right, so let's get to the real meat actually in our loan closing process. So, I'm honored to have Nick as a partner. Nick and I have been partners since 2015, and we've gotten into many adventures, some not so great. And we've learned a lot about business, obviously, about real estate, obviously. But I think he and I are on the same page that lending is probably the best business because we don't like to lose money. Like Nick and I we're not terribly risk averse, I guess, or we maybe are very risk averse, as we put it, like risk takers. And so we like growing our money slowly, at 10 to 12%, but we like growing it slowly, and we like the nature of compounding. And the lending business seems to be the only industry that offers that on a consistent basis. And so, we preach that to our investors, but Nick and I, that's our philosophy. And then Nick has a lot of managing the operations. I'm grateful for him to manage it because it's not easy closing 30, 40 loans a month. And then on top of that, servicing another 300 loans that's on our portfolio. And then, the 20, 30 loans that get paid off every month. It's a lot. That's a lot of stuff going back and forth. Unfortunately, Nick's supported by a great team that he selected. And then he also selects our software and all the tools that we use to manage all this stuff. So that being said, Nick, I'd love to hand the floor over to you if you want to have any opening remarks.
Yeah, sure. Yeah, appreciate it. Thanks, Samir. So I'll just start with this. It may be I don't mean to insult anyone's intelligence or anything like that, but the loan closing process is really a lot of different things all coming together. So I kind of see myself as something of a conductor. When there's a real estate transaction, it's not just the loan to the borrower, right? There's probably 5 to 10 transactions going on in every loan closing. There's obviously our transaction with our borrower, right? The loan that we're making to our borrower, but there's also the sale from the seller to our borrower or buyer. There is often some change of servicing from one owner to the other. There is also the purchase by our borrower. It depends on the state, but there's the purchase of title insurance that may be done by either seller or buyer in favor of the buyer and the lender. There's also purchase insurance by either seller or buyer in favor of the buyer and the lender. There's also transactions being tax authorities and various jurisdictions as well. So it's really an orchestra of transactions going on. As kind of the leader of this part of the loan process, I'm working with my processing team, internal Trophy Point. I'm working with our underwriters to ensure, so between our process and that everything the underwriters approved goes into the loan file. And then, coordinating with our attorneys, paralegals, closing specialists, title examiners, and everyone's number one goal is to give, and what I constantly am conveying to every member of the team is our number one goal is to give our borrowers a seamless closing from origination to funding, disbursement, and beyond into servicing. So how do we do that? Like I said, it's really a team effort. It kind of gets to my desk. My whole processing team has guided our borrower to get us all of the documents that are required in order to turn the loan into an asset for Trophy Point, and ultimately for you, the investors. So how do we do that? We're obviously looking at every single document, making sure it comports with our set of requirements. And that includes credit reports, bank statements, experience scores, what sort of other income they have. There's an in-depth construction feasibility study for every loan that involves any sort of rehab component. And then we look at the property itself. We're a team of title examiners who are reviewing title documents for accuracy, trying to make sure that the file's in order, reviewing minor details like a street address, to much larger things like potential for encumbrances or superior liens, whether that's from a tax authority or from a previous owner who may still have a claim, or a tenant that may not be listed. So our title examiners are reviewing all of those items to ensure that at the end of the day, our collateral is free and clear and can do work for us. And that work is serving an asset for the company, but also potentially being pledged to a bank partner. Do doc prep, right? So every closing, somewhere 65 and 125 pages of loan documents. And so we're sure that my team is making sure that all the loan details are correct, right? We have very strict guidelines, but the way we make money and serve our customers best is by sometimes making exceptions to those. And those exceptions, require some changes in terms, whether that's additional fees, whether that's more time, whether that's interest rate, what have you. Work with our borrowers to kind of create a bespoke product and back it up with the legal documents that we need in order to ensure that our collateral is protected. So we're reviewing everything that our sales and origination team has put together and agreed to with the borrower, and then issue our borrowers a final loan commitment that details all of those items and how they will expect to see the agreed terms in the 65 to 100 and some odd pages of documents that they will sign the next day or two. And then then finally we have kind of my piece. We have the closing coordination. So again, it's there's this probably maybe 10, 15, sometimes up to 15 actors involved. So working with everyone to ensure that we're closing on the right date. Our funding team is in sync and know exactly how much we're charging in fees, how much the borrower is expected to bring, and no detail is really left unnoticed. Working with some agents to ensure that they have a really swift closing experience, and ultimately a borrower gets the property, can begin work on the property, and we can then turn around, take that asset, and put it on our balance sheet and put it to work. And so, as as I'm talking, you can see all of the items here that we're doing. I'll kind of go through, kind of explain what it is we're doing in each of these steps here. So I've received the application. We're checking to make sure this is the place we want to lend, right? That's kind of the first thing. We're looking at the borrower. Is this the type of borrower we want to be working with? And after we sync internally on those items, we'll submit some options for our borrower, and then really and expect our borrower to sign our initial loan term sheet. Our team on the back end is checking comparable sales in the property. We're checking their credit score, checking liquidity, checking and verifying experience through a number of software tools that we have at our disposal, and then coordinate with the title insurance company and hazard insurance. Some of the most important items that we're looking at are in coordination with these third parties to ensure that our collateral is protected in the event that there is a claim on title, or, and this rarely happens, but in the event that there is some sort of hazard, whether that's a fire or a theft of materials on the job sites. We're working with these third parties to ensure that at the end of the day we are protected, not just 100%, but we protect ourselves 125%. So we always require our borrowers to obtain not just insurance for title and hazard at 100% of kind of the replacement value of the property, but really beyond that at about 125%. And then once we've checked all those things, we're closing the loan, as I just kind of talked about, and then you're recording our security interest, and then move it on to servicing. So
Nick,
that's
real quick,
yeah.
So like the process definitely has like a lot of facets in it. Can you talk about like how like the risk management process doesn't end with Dave doing the review or checking comps? Can you talk about like how risk management continues across the process?
Sure, yeah. So our underwriting team does kind of those first few steps, and they're looking at really the property itself, make sure that the collateral seems to be in order, right? And it's worth what the borrower thinks it's worth. Our team goes to a third party, reached out to a third party to obtain an independent valuation of the property. And that's one of the very first risk mitigants is that we internally are looking at the value with a very keen eye towards protecting our interest. And we also hire a third party to double check. And this particular third party that we use on the vast majority of our loans, they have a special expertise in construction lending. A lot of times in the traditional bank loan process, well, every bank loan process, you'll get an appraisal. Appraisals on existing structures and their existing condition it's not necessarily easy, but it's a little bit more straightforward. What we ask our partner Richer Values to do is to take the existing structure, evaluate what what they believe it's worth today if no work is done to it, but also do a feasibility of take the borrower's construction rehab strategy, layer it on top of the existing structure, and then look into the future 6 months, assuming all of these the borrower does what he or she says they're going to do, and assuming the macro environment has changed a little bit in 6 months, what will that property be worth in the future? That's why we're reaching out to Richer Values to do this, is because they have a special expertise in that, and they do this all over the country. Whereas appraisers sometimes they can be hit or miss. We're checking that against another data source that we have called PropStream. And so sometimes there's a variance, and so we're as Samir said, we're pretty risk averse, so we'll take the lower of the two values. Then we're as Samir mentioned, we're doing things to check the borrower, right? We are looking at their credit reports, and not just the score. Sometimes people have decent scores, and there can be concerning things on there in the borrower's past. Conversely, sometimes a score may not best represent what is really going on with the borrower. There are situations where we'll make exceptions and potentially lend to a borrower with a lower score than we might otherwise accept, in exchange for reduced leverage, perhaps, or additional collateral. And so those are some of the things that we're doing, through this process. We're trying to, sales or origination team will make an initial offer to the borrower, but as we go through the process, we may find that the value isn't what we expected. So, we'll go back, have a conversation with the borrower. Sometimes they will get the seller to reduce their sales price. And other times we might just say, you know what, and actually, this actually happened just yesterday. We had a borrower come to us with a property, and the sale price was actually only $50,000. Our valuation internally said that it was probably worth about $43,000. And then we did obtain a richer values report, which said it actually was worth $40,000 as is. So we went back to the borrower and said, you know what, based on these factors, we can lend you less. Or you can go back to the seller and see if they will reduce the price, given what our third-party analysis is saying. And our borrowers really appreciate that. We didn't just say, oh, well, no, we're not going to do the deal. We said, go back and talk to them. And they went and talked to the seller. The seller reduced their price. And now, we're lending less on a property that is still going to end up being worth the same in the future as we had expected. Just the initial value today is lower than the borrower had previously expected or the seller really wanted. The last piece I'll mention in terms of kind of risk mitigation is title. Title insurance is incredibly important for us, especially in the types of transactions we specialize in. We're not doing, we don't typically do a lot of brand new construction, although we are moving in that direction. What we generally do is we lend on distressed assets. Distress might mean divorce, might mean death, might mean some sort of disaster has occurred with a previous owner. And a lot of times, those 3Ds lead to some issues on title. And so, like I said before, our title examiners are looking at the commitment that we obtain from one of the national title insurers to check what might be on the title commitment. Is the chain of title, the transfer from one owner to another, is it clear? Are there any gaps? Is there maybe a question about ownership? Do some of we had an example where we had a seller who had inherited a property alongside 11 siblings, and the title company, at our direction, they had to go back to each one of the children who were inheriting the property and obtain an affidavit from them saying they don't claim any part of it. In this situation, one of the children received basically the entire proceeds of the estate, and the other siblings, although they were listed, they didn't receive title of this property. So as out of caution, we had the title company go to each of the siblings or children to sign an affidavit saying they don't have any interest in this property, even though the probate made it a little bit unclear. So those are some of the things that we'll do to ensure that throughout this entire process, we're reducing risk for us and our investors.
Yeah, and part of that is like the documents, right? Like, Nick mentioned that a loan document, can be, in excess of 100 pages. And so, part of what Nick's team does is ensuring that the promissory note is accurate, the loan agreement is accurate, the construction addendum or, the construction part of the loan is accurate. You've got all these other things that have to happen within a loan. And that's a form of risk mitigation, actually, because we obviously want to be secured by the asset, but we also want to secure the obligation from the borrower to us, right? And we also personally guarantee, we ask for personal guarantees from our borrowers. And so it's a lot of paper, like it's substantial. And it's one of the differentiators between small lending organizations versus medium size and large size. And I think I'd put us in the medium size now. A year ago, 2 years ago, I probably would have said we were on the smaller size. But when you do 100 million plus loans in a few years, like you're starting to get in the medium sized segment of the private lending space, at least. And our ability, led by Nick and like the technology and all that stuff that we use, now we have like a clear path to lending out, 100, probably $100 million a year. assuming we have the capital for it and, the team is in place. Nick, do you want to like briefly talk about like the three buckets of borrowers that we are seeing?
The most important for us, and Samir said it at the outset, is that we have a huge number of repeat borrowers, which is a testament to the entire team and the experience that that our borrowers have. They just keep coming back to us. There are cheaper options out there, and we are not the cheapest, but we are generally the best and the fastest. Generally about 50% of our borrowers, our loan volume, comes from these repeat borrowers who have done 5, 10, 20. We even have one borrower who has done over 100 loans with us. He has a very particular niche, and he's doing very short-term loans, mostly in the Savannah market, Savannah, Georgia market. These borrowers, they have teams of people that are vetting their deals. They have teams that are dedicated to ensuring that they basically have kind of mini closing departments on their own. They may have a closing coordinator, transaction coordinator, who is basically replicating all of the things that we're doing on our end. And that's verifying and making sure that all of their liquidity documents are constantly updated. They have their own teams that are checking values, and before we see one application from them, they have pre-screened or screened out probably 100 properties. We're really just getting the best loans in the markets that they're working in. In exchange for the kind of the work that they're doing and the kind of quality of their deals, oftentimes we give them discounts on their rates, and we become comfortable with that because we see after you do 5+ deals, the rate of defaults or even a late payment or any issues at all with servicing, which takes time and money, drops down dramatically. And so we're able to spend less of our team's time on underwriting, processing, and servicing those loans than for someone who's only done 1 to 3 loans. And so while for a traditional borrower we might charge 3 to 4 points, for some of these folks maybe we'll charge maybe 2 points. And then we also have the emerging professional category who've done 3 to 5 deals with us. These are repeat borrowers. They've come to us before because we've followed through. We've executed properly for them. Generally, they're not really rate sensitive. Really, they are more concerned about certainty of execution, which we pride ourselves on. Sometimes their deals are a little bit larger than our volume clients. They might seize opportunities where maybe they're 300K or maybe even a little bit more sometimes. And that generally makes up about a quarter of our volume. And then our opportunistic deals are another quarter or so. It varies on what exactly the borrower is looking for. But these folks, they may not do a lot of deals with us, but the ones that they bring us or the ones that we elect to do are really the better ones. For every one loan we do, you are probably rejecting 10 of these types of deals, maybe even more, because sometimes the conversation goes like this. They say, hey, I got a quote from some major competitor, Wall Street backed competitor. What can you? I've heard about you guys. What can you do? I have a closing in 30 days. And for those types of situations, generally we'll say, you know what, we're probably not the best fit for that. Another situation might be they present us this deal and they say, hey, this is a really good deal. Here are my numbers, and this is how much money I'm going to make. And then our underwriting and sales teams will look at the deal, and they may come to a different conclusion. And they'll say, you know what, and have an honest conversation with the borrower. And they'll say, you know what, you probably aren't going to make as much money as you think. In fact, we have a concern that you won't make any money at all. And so we're going to decline this deal, but come back to us when you have another one, and we're happy to kind of walk you through what a good deal looks like. And so for some of those folks, they may bring us 2, 3, 4, 5 deals before we say yes to one, because we kind of know know where we're strong, and we aren't interested in just doing a single deal with one borrower. When we take on a new borrower, our expectation and goal is to turn them into a repeat borrower. Because that creates a lot of efficiencies for us. It just makes us a stronger, stronger operation.
Yeah, well said. Well said. So I think we're coming up on the end of the webinar or the investor call, but there's always been a question of like, how do we make money as a firm? And so I threw this slide in there. That was a perennial question over the last few webinars, but we typically charge origination points, which is like a percentage of the loan. So 2 points is basically 2%. So if we do a $100,000 loan, that's $2,000 of a fee that's paid to the fund. We charge interest, obviously, and it ranges between 10 and 12%, sometimes even more, based on how much money how much leverage the borrower is taking. Plus, then we have fees to cover our operational costs. And then we also have terms and extensions, and those also incur fees as necessary. When someone wants a longer term, then we'll have to charge them for that. If they want an extension, we'll have to charge them for that too. So anyway, like the good news as far as the fund is concerned is that all these fees are cumulative, meaning they all go into one pot. And all of it's subject to the first loss position as well. So it's adding, a degree of safety as well to what we do. That being said, thank you so much for joining. I don't see any questions. If you have questions, we'll hang around for a couple minutes for your questions. You can put them in the chat. You can put them in the Q&A button. My contact info is here too, so you're welcome to call me or email me if you have questions. If you loan out at 10, 12%, how do you pay out the same? I see the points, but you have expenses too. So it's a good question, Bruce. Let me go back to the chart. So we make money uniquely, actually. We flip a dollar twice in a year, actually. So we charge 3% on average 2 times because we take that dollar and we flip it out twice. So that's 6% right there. And then we charge another 10, 12%. So now you're like looking at a gross return of like, 17, 18%. And then on top of that, we charge fees as well, which are closing fees. So those fees actually cover the VAT, like 90%, 99% of our operational expense, which pays for Nick's team. So, basically the way we look at it is the origination and the fees come to us to cover ourselves, pay ourselves, and cover operations, and then the interest goes to the investor. So I hope that.
I think there was one other question in the Q&A, Samir, from.
Okay, we got one from Scott. I'll answer that one, then we'll go to Q&A. Okay, so Scott asks, what do you think of reducing interest rates will do to the ability to charge these type of rates? I think, yeah, interest rates will have an impact on the business, and it could, compress our spread as well, which is, one of the reasons why we've removed or are going to remove the 12% tier for investors. Like we've got a weighted average cost, right? Like we've got a boatload of investors earning 8%, and we've got a handful of investors earning 12%. And that is blended to create what's known as a weighted average cost of capital. We're taking steps now to reduce that weighted average cost of capital by suspending the 12% program for new investors. It is very popular. Like we're getting, $1 million investors in the door at least one a month, it sounds like, or one every 2 months. But we want to be defensive a little bit and ensure that our cost of capital is well in line with what we charge. And so we actually have room. Like we're charging on average 11.5%, and our weighted average cost of capital right now is like around 10.5. So we're still making another point of spread just on that alone. But as interest rates decline, that spread may evaporate just on the interest cost, not including origination or fees. Bruce has another one. How fast can you grow? How much can you lend out? Okay, a lot of questions there, Bruce. So we're not lending for the sake of lending. Like we lend out 5 to 10 million a month. Between me, Nick, and Dave and our relationships, like we have the ability to raise more money if we needed to quickly. Have done that in the past. Borrowers find us basically through referrals. We haven't spent any money on marketing. Do you have people everywhere, or do you travel to various places? We do try to get around as much as we can, but we have third parties that do inspections and do appraisals when necessary, or the other data sources that we look at. And there's a balance there. There is some risk that we accept with that. So far, it's working out. How much can you lend out? We lend out no more than 5% of the fund. So, if we're 70 million right now, our biggest loan will be 3.5 million. And we have done $2 million loans on multifamily properties. That seems to be a very popular asset class. And now that we're larger, we feel more comfortable doing a little bit larger loans in situations where we feel like the collateral is great and the risk is safe or safer. Valerie, okay, yeah. Are you accepting meetings? We are, if you've got a deal, for sure. Okay, well, I'll just hang around again, but this concludes the investor call for this month. Thank you guys so much for joining. Special thank you to Nick for doing a great job of explaining what he does. It can be, sometimes exasperating because he manages so much, but it's extremely important work. And so I hope you guys got something out of it, to know that we're not just like flinging paper for the sake of it. There's a process, and it's led by an outstanding individual.
Yeah, thanks.
Have a great
This
day.
is fantastic. Yeah, appreciate the time, everyone.
Thanks, and please go vote if you haven't. We'll see you later.